always, we're going to take a look at global energy commodities. Let's see how the markets fared this week. Well, Brent was down at the close of trading on Friday, but not before a massive hike at the start of the week. Good news coming out of the U.S. market with the Fed holding on interest rates and signaling a potential rate cut later in the week, as well as OPEC staying its hand on its all output cut strategy, which will continue for the rest of the quarter. WTI North America also responded a bearish note to the end of trading there in the North American market. Natural gas was buoyant, but RBOB gasoline also down. Let's take a look at Nigerian equities. Well, interesting end to trading on the all-share index, Nigeria Stock Exchange. Market cap at 57.15 trillion. Right. There was a massive sell-off on Wednesday the 31st of January. A lot of profit taking there after a really dynamic and energetic start to the year on the Nigeria Stock Exchange. It was the best performing stock market around the world in January, only second to Argentina. And there was concerns around speculative trading, but of course markets seem to have corrected themselves, profit taken during the week, but still ending on a bullish note as at the close of Friday trading. Value of deals at 23.47 billion naira and volumes at 943.5 million naira. Let's take a look at European equities and North American equities. Well, the Euro Stock 600 ended the week flat. But the all-share, the FTSE 100 in London, ended down 12 basis points. The Bank of England, of course, not making any moves on interest rates, holding interest rates at their current level. The EU, the UK, and the US are doing well to push closer to their inflation targets. Of course, inflation targeting has been going on for a while, and if markets anticipate rate cuts later in the summer, that's a good signal for demand. Stocks generally tend to rise in that type of environment. Of course, the other big driver of stock market prices around the world is corporate earnings. We're in the corporate earnings seasons. And of course, Germany, DAX, CAC, Paris, and IBEX Spain all responded positively. Let's take a look at Wall Street. Wall Street, all the major indices ended the week in green. Interesting NASDAQ because Facebook, formerly Facebook, now Meta, for the first time paid dividends, and we saw a 17% increase in the Meta stock price, helping to sustain momentum in the NASDAQ market. Dow Jones Industrial Index was up almost flattish. S&P Index was also up 80 basis points. Not a bad end to the week for North American stocks. Let's take a look at what my top business pick for this week is. Well, there's only one story I'm talking about today because I think it's a very important and strategic one for the region. It's the fact that Mali, Niger, and Burkina Faso issued a statement during the week that they would be exiting the Economic Community of West African States, ECOWAS. And let's take a look at what this means for the entire bloc. Of course, ECOWAS is Sub-Saharan Africa's third largest economic bloc. So it has a GDP of about $702 billion. Of course, Nigeria, the main driver of that, followed by big markets like Ghana, Cote d'Ivoire, and Senegal. The combined GDP of Burkina Faso and Mali is less than 10% of the total ECOWAS GDP region. If you remember last year, ECOWAS had imposed trade sanctions and economic sanctions on Niger following the unconstitutional ousting of Mohamed Bazoum in that country. So trade sanctions and economic sanctions had impacted food security and imports into the region already. And the region's trade and services trade volume is estimated at about 150 billion worth of goods and services. But the one country that's likely to be impacted the most by this move is probably Mali. Mali has a huge dependency quotient on many economies in the region. Of course, both Mali and Burkina Faso are landlocked. So let's take a look at Mali. Mali, actually, 34.9% of Mali's trade comes from the ECOWAS region compared to lower percentages brought by Burkina Faso and Niger. So it stands to be the most affected. Of course, it's a major gold producer. It also produces cotton, as does Burkina Faso. But Mali is really potentially in a bind here. If we take a look at the impact on Burkina Faso depends on the port of Lomé, it depends on the port of Cotonou for exports. there's now talks that these three countries, which call themselves the Alliance des États du Sahel, which is an alliance for Sahelian states, could be looking to export their goods via the port of Guinea-Conakry, which isn't landlocked. But the problem there is, in 2021, Guinea had a military coup, and ECOWAS also imposed sanctions on Guinea-Conakry. So it's a real challenge here for these three landlocked states. But it's not necessarily all doom and gloom. Let's take a look at some of the other statistics around regional economic blocs. So if you look at this pie chart here, you can see in the turquoise color, Burkina Faso, Mali, and Niger, which call themselves the AES, the Association des Alliances of Sahelian States, or whatever it's called, they account for about 10% of the total GDP of the region. You can see Nigeria there, the big orange, Cote d'Ivoire, Ghana, some of the other bigger economies in the region. But one thing that hasn't happened is that they haven't pulled out of the West Africa Economic and Monetary Union. This is a sub-economic bloc within the broader ECOWAS region. And what benefit does this economic bloc bring to these states? Let's take a look. So the West Africa Economic and Monetary Union, their motto is 8 countries, 1 destiny. The French acronym for WAEMO is YOEMA. And they've had an average growth rate of over 6%, at least before the COVID years. Not bad. They've also had single-digit inflation below 10%. This is the West Africa Economic and Monetary Union of Francophone West African states plus Guinea-Bissau. And they've also had solid foreign exchange reserves. The interesting dynamic here is that those reserves are domiciled in the French treasury because the CFA franc for the region, which is the currency of the West Africa Economic and Monetary Union, is pegged to the euro via the French franc. So reserves of those countries are domiciled in the French treasury. And of course, that's been a long debated dynamic, which has many political leanings. And they also have access to regional financial markets and debt on favorable terms. So it's probably strategic that Burkina Faso, Mali, and Niger have not yet indicated that they would be pulling out of this economic bloc, even though their membership of ECOWAS, of course, has now been ended. Let's take a look at some of the other dynamics of this bloc. So, if you know anything about economic and monetary union in the EU, one of the things that countries need in order to arrive at economic and monetary union is something called convergence criteria. Now, this West Africa bloc agreed a convergence pact in 2020. And in order to converge into an economic and monetary union, you have to have your inflation below 3%, public debt below 70% of GDP, and the public deficit below 3% of GDP. Now, that's a tough and a tall order for any country in the West Africa region to meet. So they ditched that in 2020. But this just highlights the challenges of moving towards economic integration, particularly if these regions are thinking of a single currency. So where does this leave us? Well, let's look at the Africa map and the West Africa region. You see the countries there in green are the West Africa Economic Monetary Union. The countries there in red are the West Africa Monetary Zone of English-speaking countries like Nigeria, like Ghana, like Gambia, Liberia, and Sierra Leone. And of course, the entire ECOWAS region. The future is uncertain, but what we do know is that the economic impact of this decision by Burkina Faso, Mali, and Niger to pull out of ECOWAS may not be as damaging as if they had decided to pull out of the economic and monetary zone, the CFA franc zone, which still, by and large, remains intact. That's it for this topic this week.